Welcome back, traders. So today we're going to be discussing candlesticks and how important they are and how do we read them. So most people, when they look at a chart, they don't really take candlesticks into consideration when deciding they're going to put on a trade, right? They just go based on hope. So today we're going to make sense of these candlesticks and what they mean. So if we look at these candlesticks, we have a bullish candlestick and we have a bearish candlestick. The candlestick is made up of an opening price, the high price, the low price, and the close price of a specific period, right? So if we're looking at a 1 minute chart, that means that that's going to be the high, the close, the open, and the low of a 1 minute. If we're looking at a 5 minute chart, the same rules apply. If we're looking at a 10 minute chart, same rules apply, right? And vice versa. So now, when we're looking at this candle, the high of the price is where the upper wick is, the close is at the top of the real body, and the open is at the low of the real body, and and the low is at the lower wick, right? So we're going to get into what these wicks mean. If we look at the bearish candlestick, we see that it's opposite. You see how in the bullish candlestick, the price closes at the top and opens at the bottom? In a bearish candlestick, price opens at the top and closes at the bottom because price is heading lower, right? So if we look at the long-term chart right here, we see it just looks like a bunch of candles, right? But let's come to the next slide. We have the 5-day, 5-minute chart. So you would start to see candles that look more defined, such as these, right? So what do these mean? Candlesticks represent price action over a defined period of time, whether it's the 1 minute, the 5 minute, the 60 minute, the 1 day, the 1 week, the 1 year, whatever it is. All candlestick patterns can be used on any time frames. A pattern on the 1 minute chart would be used for a short-term day trade. A pattern on the 1 day chart would be used for a long-term position that would likely be held a few days to a few weeks. So if you're swing trading, right, you're going to be wanting to use a longer time frame, and you're going to want to take those larger candlesticks into account rather than looking at a short-term weekly chart or a monthly chart, right? So me personally, when I day trade, I like to look at both the long-term perspective and the short-term perspective, but I make decisions if I'm intraday trading off of those intraday candles, right? So now let's look at the next slide. When you start seeing a long upper wick on a candle in an uptrend, that's a bearish reversal sign, right? So if we're traveling up, we're good, we're rallying. Now we start to see this form right here. This means that the sellers are taking control, right? Because now the candle did open here, yes. And it got all the way up to here, but guess what? The sellers came in, pushed price all the way down, and closed the candle here, right? Now, it opened up here. Buyers tried to push the price up. What happened? Price fell all the way down and closed here. Then price opened here, tried to push up, came down, closed here. So now we can see how this long shadow or wick, whatever you'd like to call it, means sellers are taking control. If we look at the right side of the screen, we'll see the long lower wick on candles in a downtrend can be a bullish reversal sign. So we're coming down, we're pulling down. Let's say we come to a support line. Let's say a support line is about here, right? We have closed here, but it came down, right? Sellers pushed the price down, but guess what? Buyers came, pushed it back up, closed the price here. Ready? Opened here. Sellers tried to push it down, but what happened? Came back up, closed at the same spot that the bearish candle closed on. The bullish candle opened on, pushed up, closed, opened a new candle that was equal or a little bit higher than the last one, and pushed up more. So now if we look over, we have something called dojis, right? It's basically a candlestick with virtually the same open and close, which often indicates a reversal, but not always. So we'll see a lot of these doji candles if we're trading pre-market or we're trading aftermarket. Normally, we won't really see these candles during the normal trading session. We will, but it's not going to be as frequent, right? So basically, let's look at the right chart now. So we see down here, we had a doji form, and then another doji form. We had a bearish pin bar, right? Even though the candle was bearish, what happened? If we look back a chart, look, This means that buyers are taking control. See how we had a bearish candle, but this still was very significant because this means that the buyers are going to take control. So if we looked at the chart here, right, buyers ended up taking control. It's a bearish pin bar. So if we come over here, we have a couple dojis. Some are called gravestone dojis, dragonfly dojis, regular dojis, all different types. But let's get into, I'm going to show you an example of one specific pattern, and then I'm going to leave the rest of the patterns to part 2 of this video. So in part 2, we're going to get into reversal patterns, continuation patterns, candlestick patterns, all different types. So let me show you a little sneak peek of what we're going to be getting into in part 2 of this video. Tweezer bottoms, right? Tweezer bottoms are bullish. These will normally form at a support, right? So if you see this at a support, that means price opened here, closed here. Then the bulls came in, opened up price here, closed it up here. And now if we're at a support line, that could be a very good indicator that we're going to have a turnover to the upside. So now if we're looking at tweezer tops, which are bearish, and you see it at a resistance line where price is having trouble breaking past, that could be a good indicator to go short, right? Because look, price opened here, closed here. Then price opened here and closed here. And especially if this is forming at a resistance, definitely would want to go short with a tight stop loss depending on other factors, not just candlesticks, right? Candlesticks aren't a confirming indicator alone, right? We need to combine it with other indicators to increase our probabilities of being right. So now let's look at an example on tweezer bottoms at support on an uptrend. So we could also use moving averages as support and resistance. I'm sure some of you know that are watching this video. If you don't, well, now you know, and we're going to go over that in future videos. So if we look at a tweezer bottom that's forming at a support, right, it closes on the support, but it wicks lower, showing that buyers are taking control. Then price opened up here, closed down here, but buyers were taking control. Then what happened? Price opened up here, sellers tried pushing it down, but the buyers said nope, pushed price all the way up, and closed equal to the last high of that candle. Then what happened? Because this was a tweezer bottom, which was bullish, and it formed at a support, what do? We pushed off of that support and continued an uptrend. So let's look at another example. Same, tweezer bottoms form at the support, tweezer tops form at the top. So in the next video, these are going to be some of the candlesticks that we're going to go over, and we're also going to be going over continuation patterns and reversal patterns. And these are more patterns as well. We're going to be going over the difference between bearish trend patterns and bullish trend patterns and everything in between. Thanks for watching. Everyone have a blessed and successful trading week. Be ready for part 2, Introduction to Advanced Candlesticks. Everybody have a great day.